Thank you, Mr. Chairman. I wonder if you could help me understand the kind of logic, if there is one, inside the SCP here. Uh, as I look at the median forecast, for example, for unemployment, it runs for the 3-year window below the long run rate. I look at inflation being above over the 3-year window, the long run, or call it the neutral rate, so the economy still runs hot. And that is all true in a regime when you run, at least for 2 years, the funds rate above the long run rate. So I guess my question is this: are you not give a forecast here that essentially suggests you will be continuing to run further behind the curve and never really get in front of inflation because the economy will continue to run hot? And kind of on a related issue, you said earlier, inflation will take longer to return to price stability than we had originally expected. Isn't that a choice you're making? And if so, why are you making that choice to let inflation run above price stability longer than you'd like?
Right. So our if you look, first of all, there is no, you're looking at medians, but understand that there's no, it's not something we voted on. It's not a plan. But if you look, people do have their by the end of this year, broadly, people are at or close to, or in some cases above, their estimates of longer run neutral interest rate. Okay, so that should stop pushing. That should, in other words, that should be a removal of accommodation for monetary policy, basically. At the same time, we will have done significant balance sheet runoff, and you can think of that as further. In the next year, and just looking at the median, you're now above above the what people estimate to be the longer run median. And also in many people's forecasts, that actually amounts to tight policy in real rates as well. So why does unemployment remain at 3.5%? A couple points. One is the connection between in the economy we had before the pandemic, the connection between inflation and the level of the unemployment rate was not very tight. But this is clearly what this is an expectation that really it amounts to the idea that wage increases, which are now running above the level that would be consistent over the long run with 2% inflation, will move back down to levels which are still very attractive, full economy full employment kind of wages, but not to a point where they're pushing up inflation anymore. And as I mentioned, there are a lot of factors causing inflation to come down. The reality is there are many moving pieces, and we don't know what will actually happen. But no matter what happens, this is a committee that is determined to use its tools to make sure that higher inflation does not become entrenched. And so we are determined on that front, and we'll deal with what comes. This is a modal or most likely expectation, but we'll deal with what comes, whether it's better or worse.